Every time you swipe your credit card, you feel like you're the customer. The bank gave you a card, you use it to buy stuff, maybe you pay it off at the end of the month, maybe you don't. Either way, it feels like a straightforward deal. You borrow, you repay, done. But credit card companies are not in the business of lending you money as a favor. They've built one of the most profitable machines in the history of finance, and most of the people feeding that machine have no idea how many ways it's extracting money from them simultaneously. Not one revenue stream, not two, at least 4 major ones running at all times, some of which make money off you even when you think you're beating the system. If you're the person who never gets it until someone gives you the right analogy, this channel is for you. Subscribe. Let me walk through each revenue stream one at a time, because once you see them all stacked together, you'll never look at that little plastic card the same way. The first and most obvious way credit cards make money is interest. This is the one everybody knows about, and it's the one the companies want you to focus on because it distracts you from the other 3. When you carry a balance from month to month, the credit card company charges you interest on whatever you still owe. Average rates right now sit around 20 to 28% annually, which is higher than almost any other form of consumer lending. But the number itself isn't what makes it so profitable. The structure is. Think of credit card interest like a toll road that gets more expensive the longer you drive on it, but the signs only show the price per mile, never the total trip cost. You owe $1,000. The company charges you roughly 20% per year, which sounds manageable. But that interest compounds monthly. So next month, you owe interest on the original $1,000 plus interest on last month's interest. The road keeps getting longer while the tolls keep stacking. The minimum payment is the stroke of genius. Credit card companies don't want you to pay your balance off. They also don't want you to default. They want you in the sweet spot, paying just enough to stay current, but never enough to escape. The minimum payment is carefully calculated to keep you on that toll road for as long as possible. A $5,000 balance at 24% interest, paying only minimums, takes over 20 years to clear, and you'll pay more than $8,000 in interest alone. You bought $5,000 worth of stuff and paid $13,000 for it. That's revenue stream 1. But here's what most people don't realize. Interest isn't even the biggest moneymaker for a lot of card companies. The second revenue stream is interchange fees. And this is the one that's almost invisible to you because you never see the bill. Every time you swipe your card at the store pays the credit card company a fee, usually somewhere between 1.5 and 3.5% of the transaction. You buy a $100 jacket, the store only receives about $97. The other 3 go to a split between your card's issuing bank, the payment network like Visa or MasterCard, and the store's payment processor. Think of the credit card company as a landlord who owns every cash register in the country. They don't sell anything. They don't make anything. They just stand between the buyer and the seller and take a small cut of every single transaction that passes through their register. Millions of transactions per day, billions per year. A few percent of everything adds up to an almost incomprehensible amount of money. This is why credit card companies push so hard to get you to use the card for everything. Every coffee, every grocery run, every gas station stop. They don't care whether you pay your balance or not for this particular revenue stream. They make money the instant you swipe. The more transactions you run through their register, the more rent they collect. And here's the part that should make you pause. Those rewards points and cashback offers you love. They come from interchange fees. The credit card company takes 3% from the store and gives you back 1 to 2% as rewards. You feel like you're winning. The store is eating the cost, which means prices go up slightly for everyone, including people paying cash who get no rewards at all. The rewards aren't a gift. They're a bribe funded by everyone else's slightly higher prices. Quick favor before the next part. If this is starting to shift how you see credit cards, hit the like button. It genuinely helps this video reach other people who need to hear this. Back to it. Revenue stream 3 is fees, and I don't just mean the annual fee on your premium card. Credit card companies have built an entire ecosystem of penalty fees designed to extract money from mistakes. Late payment fee, typically $30 to $40. Over limit fee. Cash advance fee, usually 3 to 5% of the amount, plus a higher interest rate that kicks in immediately with no grace period. Balance transaction fees. Foreign transaction fees. Think of these fees like a hotel minibar. The room rate is the main price you agreed to, But then there's a $6 bottle of water, an $8 bag of cashews, a $12 tiny bottle of wine. Each one seems small. Each one has a markup of 400 to 800%, and the hotel is counting on the fact that you're tired, it's convenient, and you won't do the math until checkout. Credit card fees work the same way. Nobody gets a credit card planning to pay late fees, but life happens. You forget a due date, you overdraft, you pull cash from an ATM while traveling. Each of these triggers a fee that seems minor in isolation, but adds up fast, and the company has structured the system to maximize the chances of you triggering at least a few of them per year. The cash advance trap is particularly nasty. Most people think their credit card's interest rate applies to cash advances the same way it applies to purchases. It doesn't. Cash advances typically carry a higher rate, charge a flat fee on top, and start accruing interest immediately with no grace period. That ATM withdrawal at the airport didn't just cost you the $5 ATM fee. It started costing you 27% interest from the second the cash hit your hand. Revenue stream 4 is the one nobody talks about, and in some ways it's the most valuable of all: data. Every time you use your credit card, you're telling the company what you buy, where you buy it, when you buy it, how much you spend, what categories you spend in, and how your spending patterns change over time. That information is extraordinarily valuable. Think of your credit card as a diary you don't know you're writing. Every swipe is an entry. Bought groceries at 6 p.m. on a Tuesday. Filled up gas every Thursday. Spent more at restaurants in December than any other month. Subscribed to 3 streaming services. Travels domestically twice a year. Credit card companies use this data to build risk models, target you with specific product offers, sell anonymized spending insights to retailers and marketers, and adjust your credit limit and interest rate based on your behavior. When your card company sends you a pre-approved offer for a balance transfer or a new card, it's not random. They read your diary and noticed you're carrying more debt than usual, which means you're more likely to accept. They also sell aggregated spending data to hedge funds and investment firms who use consumer spending patterns to predict company earnings before they're publicly reported. Your coffee habit at Starbucks, multiplied by millions of other cardholders, helps Wall Street predict Starbucks' stock movement. You're not the customer in that transaction. You're the product. Let me stack all of this together so it locks in. Interest is a toll road that gets more expensive the longer you stay on it, and minimum payments are designed to keep you driving forever. Interchange fees make the credit card company a landlord collecting rent on every cash register in the country, and your rewards points are funded by slightly higher prices everyone pays. Penalty fees are the hotel minibar, small charges with massive markups that the company expects you to trigger. And your spending data is a diary you don't know you're writing, sold to marketers, retailers, and Wall Street. 4 revenue streams running simultaneously: interest, interchange, fees, and data. Even if you pay your balance in full every month and think you're outsmarting the system, the company is still collecting interchange on every swipe and reading your diary every night. Credit cards aren't evil, they're tools, but they're tools designed by people who understand human psychology better than most humans understand themselves. And the gap between what you think is happening when you swipe and what's actually happening is where the profit lives. If this helped you finally see how credit cards actually make money, do me 2 quick favors. Hit the like button and subscribe so you catch the next one. I'm deciding between 2 topics for the next video, and I want you to pick. Should I explain how insurance companies make money using a casino analogy? Or how taxes work using a subscription service analogy? Drop A or B in the comments, and whichever gets more votes, I'll make first. Thanks for watching.